Asia was a softer session, Europe was a softer session, and as you say, we shrugged it off. The other point of that China trade data, I guess, is that it was weakness really of China's trade with Europe and Japan more than the US, as Art was pointing out, which comes back to that point that the US economy itself is still okay.
Seems fine, and I do think you're right that basically traders could have over-extrapolated the Chinese numbers and again, kind of pressured the market. We've seen this pattern in the last few weeks where any weakness in the morning tends to be picked up and people feel maybe underinvested a little bit, and you've had real strong rotation. But yes, the growth stocks were weak today. Apple was down almost 2%, and you definitely had some weights in there. But I think it's really kind of an inconclusive day rather than a day that makes you stand up and say, okay, is this rally in jeopardy? We don't know yet.
So, Jim, where are you on this market that is still off 12% from the highs? Big downturn, big comeback, still lower.
We still haven't solved anything technically. I've been saying that every time I come on this show, but it's still true. And you mentioned levels, 2,600 on the S&P is its technician's dream. It runs right up into it and then sells off a little bit. We have the 200-day moving average to overcome in these moving averages for these indices as well. Yet we're well above the lows, and we're starting to see some stronger closes. I would mention also the budget deal was also another piece of bad news that could have impacted the market today. There wasn't any particular the lack of a deal. There wasn't any particular news, but the longer these go on, the more chronic they get and the more painful they get. I think the market looks okay, and the economy, as Michael mentioned, is really doing pretty well. If you look at retail sales, consumption is higher. If you look at trade volumes, if you look at overall freight volume, it really spells pretty good things for the U.S. economy. We may be decelerating a little bit, but unlike the rest of the globe, we're still moving in a positive direction. It certainly doesn't spell recession. I just want to point out two other things. High yield spreads have come way back in over the last few days. That's a sign that risk-taking might be peaking its head above, and that rotation that you mentioned out of growth into value. You and I talked about emerging markets last time. They've been fairly strong, and the dollar's right on support. But if it gets any weaker, I think you'll see these international areas start to move.
So Jim, talk to us about your positioning in light of that. Are you avoiding anything with international exposure, given the China trade data that we had, and just focused on U.S. consumer or U.S. banks?
We do think value is going to outperform finally. It's been almost the boy who cried wolf now for about 5 years, but it's starting to show peek its head up. You have to be a little bit careful about getting too excited about the banks, because look at where spreads are. 10-year Treasury at 2.7%. And if you do see any slowdown in the U.S. economy, what's going to happen with lending? The loan officer surveys are really good, and the valuations are really good for the banks. We're only looking at about 4% earnings growth, though, for the market. So where are we positioned? We still have an abnormally high level of cash in our portfolios. We've got some gold equities that have been mixed in there as well. So a little more defensive, but on the dips, we're starting to buy things. And on rallies, if we have something we don't want anymore, we're starting to prune those.